What's going on, everybody? Welcome back to another Discord only options curriculum video. So in the previous update, we just went over the basics of what calls and puts are. Now we're going to take it a little bit further and we're going to go through an actual options chain because when you're trading options, you have to know what you're looking at on the options chain. So we want to make sure that everybody knows exactly what you are seeing. We're going to go over expiration dates. We're going to be going over strike prices as well, the bid and the ask spread, and the Greeks. The one thing that I want you guys to understand, though, when we're looking at the Greeks, is I don't want you guys to be getting analysis paralysis. Once we go through some of this information, I want you guys to understand the broad concepts and apply those concepts to maybe this might be an expiration date that I do want to trade, or this might be an expiration date that I don't want to trade, or maybe this option or this stock right now has too much implied volatility baked into the options chain. That's what I want you guys to understand, because if you sit there trying to calculate, well, this is the delta, this is the gamma, this is what the theta is saying, this is what the vega is saying, by the time you complete that analysis, the trade is already over. So let's pull up the actual option chain right here. This is what we're going to be looking at. We're going to be looking at the Apple expiration date right here. So when we're looking at the Apple July 15th expiration date, as we can see here, there's a lot of different expiration dates. That's part of that options definition that we went over in the previous video, which was talking about, well, when you buy a call, you own the right but do not have the obligation to buy 100 shares of stock on or before a specified date. The specified dates are these expiration dates that you're seeing here. Now, another part of that definition is at a specific price. When you're looking at the specific prices here, that's what we call the strike prices in the options world. So anything that is going to have, specifically for calls, when you are buying calls, anything that it has a strike price below what the stock is currently trading at, that's classified as an in-the-money call. And anything that has a strike price above where the stock is currently trading at, and this is Apple right here. Apple closed at 141.66, so any strike price above 141.66, so 142 and above, that's going to be considered an out-of-the-money contract. Now, at-the-money contracts are these contracts surrounding here, these 141s, 142s. So those are the basics right there of kind of reading the first two steps of the option chain. There's the expiration date, and then there's the strike prices. Now, when we take a look at the bid and ask spread and what the actual bid and ask are, you're going to see these right here. So for this $142 strike for Apple that expires on July 15th, you see 3.95 is the bid and the ask price is 4.3. Now, typically, when you're looking at options, there's going to be somewhat of a spread. The difference between the bid and the ask is what we call the spread. The other thing that you guys have to think about too is that every single time that we're looking at an options chain, when you're buying the right to 100 shares of stock, well, you have to multiply everything by 100. So when you see 3.95 here on the option chain, the bid is actually $395 and the ask is $430. Now you also have the mid price down here at 412. That's typically what you want to attempt to get filled at. It's not going to happen all the time. Sometimes you have to mess with it, but we can talk about that in a later video. Now, I want to get into the Greeks with you guys. So the first Greek that we're going to be talking about is delta. So the main definition of delta, or a question that you can ask yourself when you're thinking about the Greeks, is how sensitive is this options contract to XYZ? For delta, you're asking yourself the question, how sensitive is this options contract to a $1 move in the underlying stock? So when we pull this screen back up over here and we actually look at what the delta ratings are, on this $142 strike for Apple, the delta is 0.5. So all other things in the market being held equal, you would expect to see a 50 cent or $50 increase in your options contract if the stock were to then go up $1 after you bought the contract. The other way that you can essentially read delta is, what is the probability that my options contract is going to expire in the money upon expiration? For these at-the-money contracts that we're seeing right here, it's about 50-50. For the deep in the money contracts with deltas of 0.99, you're getting essentially dollar for dollar every single time the stock moves up on your options contract. So every single time the stock moves up $1, your options contract increases $100. That has about a 100% chance or a 99% chance of finishing in the money upon expiration, when expiration comes around, which this options expiration date that we're looking at right here on this chain is July 15th. Now, again, moving on, we're going to be talking about gamma. So what essentially gamma tells you is, well, what's the rate of change of delta? Gamma is going to be highest at the money contracts because, well, that's the time you can see a lot of this fluctuate around a lot. Well, when we're looking way out here, these deep out of the money contracts, again, these have a very low probability of finishing in the money, and the stock would have to make such a significant move in order to change these deltas, because when you think about that percentage increase in the stock, you're not really getting that much closer to this contract being in the money. It's a negligible difference, so you're not really seeing that increase in gamma. Now, we're going to talk about what's, in my opinion, the most important Greek here, theta. To understand theta and to really take your trading to the next level, time decay, which is essentially what theta is the most important thing. I see a lot of new traders coming in that don't understand this concept of theta and time decay and what effect it has on options premiums, and they end up getting stopped out a lot. And we're going to go over a little example of this. But theta is essentially time decay. Now, coming over and taking a look at an example of theta, well, we know that this $142 strike right here has a theta of negative 0.09. Now, theta is negative because as every day goes on, you would expect your contract to lose in value if the stock doesn't move. So on this contract right here that has about 3 weeks of time until expiration, the theta is negative 0.09, so about $9. Now, when you take a look at the most recent expiration, or the closest time to expiration, which is next week, so it's about a week of time, the theta is negative 0.17, so almost double. So you're seeing about 2 times the time decay on your contract. Now, I want you guys to think about this in a couple of ways. If you were entering a trade on a 1348 cross, and you're going to see a little bit of a volatile move, let's say the stock starts to run up after you end up getting into that trade, but then it comes back down for a retest. So you might be up 5-10% on your trade, but then the stock starts to kind of reverse if you're trading calls, and then comes back down for a retest. If you're trading contracts with a very short time to expiration, it is very likely that you're going to get stopped out before the stock continues in that upward direction, and you would have actually made a profitable trade there. But if you get more time on your contracts, that same stop out at 10, 15, 20% with a contract with a little bit of more time actually becomes a negative 2%, negative 5% down rating on your contract at that point, and you're able to stay in that trade for longer, and you have a little bit of a larger margin for error. Now, the next Greek that I want to talk about with you guys, in my opinion, it's not as important, the actual Greek, but what it implies, which is funny for what we're about to talk about, but what it's actually reading is important, and that's Vega. So Vega is measuring an option's sensitivity to changes in implied volatility. So I want you guys to think about implied volatility in a couple of different ways. Now, first, it's the market's expectation of what a stock should move in the time period before expiration. So let's say, for example, that a stock is not expected to move at all in the time period until expiration. The market is expecting that the stock is just going to stay flat. Now, if the stock ends up making a move, well, that's a giant surprise. The implied volatility is now going to make an adjustment. You're going to see higher baked in implied volatility because, well, now the stock has shown the market that it can move, and options prices will increase based off of that, and most likely would increase significantly. But on the flip side, if the market is expecting a very large move in the underlying stock in that time frame, which we see a lot of recently, especially with people chasing these short squeeze plays, let's say the market is then pricing in a 20% move in the stock up or down, but the stock then only moves 5%. That's well within expectations, and your options contract will not go up by much, and you actually could be down. So you have to take these things into consideration when you are looking at trading options. So when you think of theta, you have to think about, okay, well, I could end up eliminating maybe an expiration date, and I want to go and get some more time when I'm getting this option. For implied volatility, you're actually thinking, well, could I eliminate this stock because I'm risking so much and the market is already expecting such a large move, when I could just trade something else that looks better, and actually have a lower and a smaller move in the stock and actually have that same gain with a lower amount of risk. So that is essentially going to wrap up the update on the actual options chain, guys. In the next video, we're going to be talking a little bit about open interest in volume. And that kind of goes towards that conversation about maybe potentially eliminating some stocks that you may not want to trade in your trading strategy. Because if you're not seeing a lot of volume or open interest, there's not a lot of action, the contracts become a little bit more illiquid, but we're going to talk more about that in the next video. So that's going to wrap up this one, people. Peace.